Blockchain technology is a revolutionary concept that has the potential to transform various industries, including finance, supply chain management, healthcare, and more. At its core, blockchain is a decentralized and distributed ledger that records transactions across a network of computers. Each block in the chain contains a list of transactions, and once a block is added to the chain, it is immutable and cannot be altered. This ensures transparency and security in the system. One of the key features of blockchain technology is its decentralized nature. Unlike traditional centralized systems, where a single entity controls the data, blockchain operates on a peer-to-peer network where every participant has a copy of the entire blockchain. This eliminates the need for intermediaries and reduces the risk of fraud or manipulation. Another important aspect of blockchain is its use of cryptographic techniques to secure the data. Each block is linked to the previous block using a cryptographic hash, creating a chain of blocks that is resistant to tampering. Additionally, consensus algorithms such as proof of work or proof of stake are used to validate transactions and ensure the integrity of the network. Blockchain technology is best known for its application in cryptocurrencies such as Bitcoin and Ethereum. These digital currencies operate on blockchain networks and enable secure, peer-to-peer transactions without the need for a central authority. Cryptocurrencies have gained popularity as an alternative form of payment and investment, attracting both individual users and institutional investors. Beyond cryptocurrencies, blockchain technology has the potential to revolutionize various industries through the use of smart contracts and decentralized applications. Smart contracts are self-executing contracts with the terms of the agreement directly written into code. They automate and enforce the execution of contracts, reducing the need for intermediaries and streamlining processes. Decentralized applications, dApps, are applications that run on a blockchain network, offering increased security, transparency, and efficiency. In conclusion, blockchain technology is a disruptive innovation that has the power to reshape the way we transact, communicate, and interact with each other. Its decentralized nature, security features, and potential for innovation make it a promising technology with far-reaching implications for the future. Cryptocurrencies are digital or virtual currencies that use cryptography for security and operate independently of a central authority. The most well-known cryptocurrency is Bitcoin, which was created in 2009 by an unknown person or group of people using the pseudonym Satoshi Nakamoto. Bitcoin introduced the concept of a decentralized digital currency, sparking the creation of thousands of other cryptocurrencies. Each cryptocurrency operates on its own blockchain network, which serves as a public ledger of all transactions. One interesting fact about cryptocurrencies is their limited supply. For example, Bitcoin has a maximum supply cap of 21 million coins, making it a deflationary asset. This scarcity is designed to increase the value of the currency over time. Another key feature of cryptocurrencies is their pseudonymous nature. While transactions are recorded on the blockchain, users are identified by their wallet addresses rather than their real names. This provides a level of privacy and anonymity, although transactions are still traceable. Cryptocurrencies can be used for a variety of purposes, including online purchases, investment, remittances, and fundraising. Some cryptocurrencies, such as Ethereum, go beyond simple transactions and enable the creation of smart contracts and decentralized applications. These features have led to the rise of the decentralized finance, DeFi movement, which aims to disrupt traditional financial systems by offering decentralized alternatives to banking, lending, and trading. Despite their growing popularity, cryptocurrencies face challenges such as regulatory scrutiny, security vulnerabilities, and market volatility. Governments around the world are grappling with how to regulate cryptocurrencies to prevent fraud, money laundering, and other illicit activities. Additionally, the value of cryptocurrencies can fluctuate dramatically in a short period, leading to concerns about their stability and suitability as a medium of exchange. Overall, cryptocurrencies represent a new frontier in finance and technology, with the potential to revolutionize the way we transact and interact in the digital age. Mining is the process by which new transactions are added to a blockchain network. miners use powerful computers to solve complex mathematical puzzles that validate and secure transactions. The first miner to solve the puzzle adds a new block of transactions to the blockchain and is rewarded with newly minted coins. This process, known as proof of work, requires significant computational power and energy consumption. Interesting fact, the total energy consumption of the Bitcoin network is comparable to that of some small countries. Validation of transactions is a crucial aspect of blockchain technology. Once a block is mined, it undergoes a validation process to ensure that the transactions are legitimate and comply with the rules of the network. Nodes on the network verify the transactions by checking the cryptographic signatures and consensus rules. If the majority of nodes agree that the block is valid, it is added to the blockchain. This decentralized validation process ensures the integrity and security of the network. Interesting fact, the decentralized nature of blockchain validation makes it resistant to censorship and fraud, as no single entity has control over the network. Overall, mining and validation are essential components of blockchain technology, enabling secure and transparent transactions in a decentralized manner. Smart contracts are self-executing contracts with the terms of the agreement directly written into code. These contracts automatically enforce and execute the terms of the agreement, eliminating the need for intermediaries and reducing the risk of fraud. Smart contracts operate on blockchain networks such as Ethereum and are executed when certain conditions are met. For example, a smart contract could automatically release payment to a supplier once a shipment is confirmed as delivered. Interesting fact, the concept of smart contracts was first proposed by computer scientist Nick Szabo in the 1990s, long before the creation of blockchain technology. Decentralized applications, dApps, are applications that run on a blockchain network, offering increased security, transparency, and efficiency. dApps leverage the decentralized nature of blockchain to provide users with greater control over their data and transactions. These applications can range from decentralized finance platforms to social networks and gaming applications. Interesting fact, the most popular category of dApps is decentralized finance, DeFi, which aims to disrupt traditional financial systems by offering decentralized alternatives to banking, lending, and trading. Overall, smart contracts and decentralized applications represent the next frontier of blockchain technology, enabling new possibilities for automation, transparency, and innovation. Regulatory challenges surrounding cryptocurrencies and blockchain technology have been a topic of debate among governments and regulatory bodies worldwide. One of the main concerns is the potential for cryptocurrencies to be used for illicit activities such as money laundering and terrorism financing due to their pseudonymous nature. In response to these concerns, many countries have implemented regulations to monitor and control the use of cryptocurrencies. For example, the Financial Action Task Force, FATF, has issued guidelines for countries to regulate virtual asset service providers and ensure compliance with anti-money laundering and counter-terrorism financing laws. Interesting fact, in the United States, the Financial Crimes Enforcement Network, FinCEN, requires cryptocurrency exchanges to register as money services businesses and comply with reporting requirements. Another regulatory challenge is the classification of cryptocurrencies and tokens. Different countries have varying definitions of cryptocurrencies, leading to regulatory uncertainty and inconsistency. Some countries classify cryptocurrencies as commodities, while others consider them as securities or currencies. This lack of uniformity in classification poses challenges for businesses operating in multiple jurisdictions. Interesting fact, in the European Union, the Markets in Crypto Assets Regulation (MiCA) proposal aims to create a harmonized regulatory framework for cryptocurrencies and digital assets across member states. Government responses to regulatory challenges have been mixed. Some countries have embraced blockchain technology and cryptocurrencies, recognizing their potential for innovation and economic growth. For example, countries like Switzerland and Singapore have established regulatory sandboxes to encourage blockchain startups and foster innovation in the sector. Interesting fact, Estonia has implemented e-residency programs that allow individuals to start and manage blockchain-based businesses remotely. On the other hand, some countries have taken a more cautious approach, imposing strict regulations or outright bans on cryptocurrencies. China, for instance, has banned initial coin offerings, ICOs, and cryptocurrency trading exchanges due to concerns about financial stability and capital outflows. Overall, regulatory challenges and government responses to cryptocurrencies and blockchain technology continue to evolve as regulators seek to balance innovation with consumer protection and financial stability. The impact of blockchain and cryptocurrencies on traditional financial systems has been profound, challenging the status quo and reshaping the way we think about money and transactions. One of the key impacts is the disintermediation of financial institutions. Blockchain technology enables peer-to-peer transactions without the need for banks or other intermediaries, reducing transaction costs and increasing efficiency. This shift has the potential to democratize finance and provide greater access to financial services for underserved populations. Interesting fact, according to a report by the World Bank, over 1 billion people worldwide lack access to basic financial services, and blockchain technology could help bridge this gap. Another impact is the potential for financial inclusion. Cryptocurrencies and blockchain technology have the potential to provide banking services to the unbanked and underbanked populations, allowing them to participate in the global economy and access financial services such as savings, loans, and remittances. This could have far-reaching implications for poverty reduction and economic development. Interesting fact, the World Economic Forum estimates that blockchain technology could generate over $1 billion in new trade over the next decade by reducing barriers to trade and enabling secure transactions. However, the impact of blockchain and cryptocurrencies on traditional financial systems is not without challenges. One of the main concerns is regulatory compliance and oversight. Regulators are grappling with how to monitor and regulate the use of cryptocurrencies to prevent fraud, money laundering, and other illicit activities. Additionally, the volatility of cryptocurrencies poses risks for investors and financial stability. The rapid price fluctuations of cryptocurrencies can lead to speculative bubbles and market manipulation, impacting traditional financial markets. Despite these challenges, the potential benefits of blockchain technology and cryptocurrencies for traditional financial systems are significant. By increasing transparency, reducing costs, and expanding access to financial services, blockchain has the potential to revolutionize the way we think about money and finance. One notable case study of blockchain implementation is in the supply chain industry. Companies like Walmart and IBM have partnered to use blockchain technology to track the provenance of food products. By recording each step of the supply chain on a blockchain, retailers can quickly trace the origin of products in case of contamination or recalls, improving food safety and reducing waste. Interesting fact, in a pilot project, Walmart was able to trace the origin of a package of sliced mangoes in just 2.2 seconds using blockchain technology, compared to the traditional process that took over 6 days. Another case study is the use of blockchain in the healthcare sector. In Estonia, the government has implemented a blockchain-based system for storing and sharing patient health records. This secure and transparent system allows patients to control access to their medical data and enables healthcare providers to access real-time information, improving the quality of care. Interesting fact, Estonia's e-health system has been in operation since 2008 and has reduced administrative costs by over 22%. These case studies demonstrate the diverse applications of blockchain technology across different industries, showcasing its potential to revolutionize processes, enhance transparency, and drive innovation. The future of blockchain technology holds exciting trends and potential disruptions that could reshape industries and economies. One trend is the rise of central bank digital currencies, CBDCs, with several countries exploring the possibility of issuing their own digital currencies. CBDCs could enhance financial inclusion, reduce transaction costs, and provide governments with more control over monetary policy. Another trend is the convergence of blockchain with other technologies such as artificial intelligence, AI, and the Internet of Things, IoT. This integration could enable new use cases and applications, such as autonomous vehicles that use blockchain for secure data sharing and transactions. Interesting fact, according to a report by Gartner, blockchain combined with AI is expected to create over $3.1 trillion in business value by 2030. Potential disruptions in the future include the impact of quantum computing on blockchain security. Quantum computers have the potential to break traditional cryptographic algorithms used in blockchain, posing a threat to the security of networks. Researchers are exploring quantum-resistant algorithms and post-quantum cryptography to address this challenge. Another disruption could come from the tokenization of assets, where traditional assets such as real estate or art are represented as digital tokens on a blockchain. This could democratize access to investments and create new asset classes, but also raise regulatory and legal challenges. Overall, the future of blockchain technology is full of promise and potential disruptions that will continue to shape our digital world.